Well, it does feel that AI has moved into a more disruptive phase 3 and a bit years after the launch of ChatGPT. And I think there's a number of reasons for that. I think primarily it's to do with AI model progress. We've seen some really powerful models coming out of Google with Gemini, but also more recently out of one of the frontier labs, Anthropic. Its Claude model has moved the agentic side of the AI story meaningfully forward. So much so that within the world of software and software coding, it's now become possible for coders to use AI to perform tasks that used to take humans hours. It's really that's driven a heightened excitement around AI, because if we're able to use AI to perform tasks without humans in the loop, we start to scale AI in a completely different way. So disruption definitely higher on the agenda. And of course, as a result of some of these changes, you've seen some of the discomfort around the software sector spread into other areas in the economy too. We've seen that with information services. We're seeing it a bit with digital platforms, even advertising. I think people are beginning to worry that in an agentic first world, what happens to some of those pre-AI profit pools? And I think that's why we're seeing this heightened sense of disruption and fear really around AI, which really reflects this AI model progress. I think the idea of AI moving into a more disruptive phase has some very meaningful ramifications for the portfolio. We've already made some very significant changes to the portfolio over the past years, reflecting our excitement, our AI maximalist approach that really wanted us to position more in favor of CapEx beneficiaries than perhaps the traditional companies and the composition of benchmarks. In more recent times, we've also significantly reduced software. We felt that the AI story was becoming more disruptive, and we felt that software might not be a beneficiary group, but actually could be on the wrong end of some of the disruption that we're now seeing via AI coding and some substitution effects that we expect to see play out more aggressively in the years ahead. The pace of this race, this AI race, is intensifying. The race is more exciting than ever. AI is more capable than ever. And what the ramifications of that are very meaningful. And obviously, the portfolio that we have today is the one that we think is the right one for today. But things are changing very fast. And so we saw recently that Google went from being perceived as a potential loser back to being very much at the front of the race with a very successful AI model of its own, Gemini. That idea of winner to loser and loser to winner is, I think, something that we should consider as table stakes in what remains an incredibly intense, ever-changing AI race. So the changes we've made, we think, position us very well for where we are today and for the immediate future. But we fully expect the AI race to take other turns along the way that will involve us moving the portfolio again and very much remaining active investment managers. Well, there are multiple risks to the AI story that we've been very clear about ever since we really came out with this idea of being AI maximalists. We believe that AI is a general purpose technology. We don't think this is another theme or another sector. This is something that's transformative in a way that electricity, steel, the internet have proved in the past. But we've been pretty clear that things aren't going to progress in a straight line. There will be setbacks inevitably along the way. And I think we've highlighted in the past that, between 1994 and 1998, so the pre-bubble years of the dot-com period when we were building out the internet infrastructure of today, there were multiple setbacks. I think 15% corrections in the NASDAQ speaks to a period of progress. I mean, really great progress, both in terms of performance of the tech sector, but also the build out of that internet infrastructure, but some material setbacks along the way. And we would expect that pattern to play out again during this infrastructure build, the AI infrastructure build that we're in the midst of. We've already seen a few of those, of course, with DeepSeek and some other more macro-related. And, again, what would be those risks today? Well, possibly macro-related. They could be supply chain related. There's obviously a subtext of within the AI story, we have an AI race between the US and China. Could that result in export restrictions? Could there be other challenges to what is a global fragmented supply chain? Absolutely. I think for us, the biggest risk, and the one that we monitor most closely, really relates to the pace and trajectory of AI model progress, because everything hangs on that. Models need to be getting better in order for the opportunity set of AI to really realize its potential. Likewise, if you're going to commit hundreds of billions of dollars for building infrastructure and new AI models, those models need to be yielding better results. So for us, that's the principal thing that we're focused on. It's why we travel the world as we do as a team. It's why we do 1,000 company meetings a year, because we absolutely have to be at the coalface of what's happening in AI for us to assess that risk. Thinking about the balance of the year, we're upbeat. I mean, we feel like we're entering the sweet spot really for AI. Here we are, 3 and a bit years after ChatGPT. It's easy to think that we're kind of in the middle of a cycle. When you step back and you think about what the agentic breakthroughs that we've seen with Claude Code and other models that we're seeing, this idea of being able to non-human scale AI in a way that we haven't before, it's possible that we'll look back at this point as the breakthrough moment for AI. And if that's true, then what should happen next is that we see models meaningfully improve. We've still got to see the first models from the Blackwell architecture from NVIDIA. We haven't had any really yet, so we've got that to come. We've got continued CapEx, we hope, is revised higher because more demand for AI requires more compute capacity, and that ought to be good for beneficiary companies. I think on the other side of the trade, we should expect to anticipate more disruption. And so while we've seen some very violent moves in markets, particularly for companies that are perceived to be on the wrong side of the trade, and of course some of those in the very near term may be overshoots, but I think that they speak to early concerns in the market around the more pernicious, the more disruptive aspects of AI that we're just beginning to see play out. So I think from our perspective, super excited about the trajectory of model improvement. The adoption in enterprise is going to be the breakthrough year, like we've discussed, and I think increasingly trying to make sure that you stay on the right side of the AI story and avoid the losers as this GPT, as this general purpose technology, moves into this ever more disruptive phase.